Hey guys, David Huffaker here with another week of information for you about what's going on in our industry and our market and what we're seeing in the trends. So I hope you guys had a wonderful Memorial Day weekend. I hope everyone stayed safe. I wanted just to bring some information to you after my week in Austin last week. Had a chance to have some one-on-one time with Gary Keller, and then also spend 2 days at our mastermind. And so me and Miss Nora back here, she likes to crawl around on my desk, and so never thought I'd have a cat, but I have a cat. So she's going to join us today. But anyways, I want to hop in real quick on some of the things, right? That the economy is top focus, right? We're working internally to build out our scripts. One of the things in a shifting market, guys, we're going to be moving from a speed-based market to a skill-based market. And so you're going to hear me for the next several months really hone in on the skills necessary in order for us to serve the consumer at the highest level. And so a lot of you will look at the market and say, David, there's nothing wrong. There's nothing going on there. And you're absolutely right. Right now, the market does not indicate that there is anything changing other than just some of the conversations we're having with our clients. And yet I'm telling from the research what the numbers are telling us and the economists are telling us. And what Gary is telling us is that there is a cliff coming, right? There is a shift coming in which, he always says it's gradual and then it's sudden. And when it does happen, we just want to be prepared for it. And I don't want to send you out to fight it and to combat it and to navigate your clients through it when it happens, right? We want to spend the next 6, 7, 8 months continually honing that conversation and honing those skills just to help the consumer be more informed. Again, that's the only reason that we really practice scripts or understand. We want to make sure that you're well-informed agents. We want to become the economist of choice. And we've said that for years. And yet in the market, it hasn't been as valuable, right? The knowledge and the data, because rates haven't fluctuated much. 60 days, 90 days ago, the conversation was, you want to buy a house, well, tell me what location do you want to be in? What's your price point? If you talk to somebody about, the LP Mama script was really valuable to uncover motivation and desire and those things. Well, that's still going to be valid. You're starting to already hear some of their fears and conversations around what about prices, what about interest rates, what about affordability, some of those things that they're hearing that just get repeated as they go about and talk to their neighbors and people in the community. And so we want to be educated, right? We want to be able to stop emotional conversation and have logical conversation, knowing that there is a lot of emotion and anxiety with the consumer right now. And so we just want to be the professional, educated realtor. And that's going to take practice over time, right? That's going to take us having these conversations with each other and with our team leaders and our ALCs in order to master the art of being the economist. And guys, it doesn't take a ton, right? I'll tell you some of the easiest things to do. Go check out cnbc.com. That's a great place to go find just information going on with the economy. Don't stay there too long because it's a lot of doom and gloom. It can be really depressing. But you can hit the highlights of the stories. And really, if you find anything about housing, just reading through those articles to see what the general trends are in the conversations being had by the financial industry and the financial market. The other place to look is at Inman, right, to get a glimpse of real estate news and agent sentiment. And then, of course, all of that is news and designed to drive clicks. And so we want to pay attention to local stats, to NAR, to what they're saying, and then really an interpretation of it. But if you were to go each day or each week and just kind of pull the headlines and see what's going on, and be able to turn around and understand how does that impact my consumer, and to see, kind of filter through the noise there, you are going to be more educated and well-versed than 99.99% of people on earth. And that's what we want to be, right, for our consumer. And so let's talk about that a little bit today. I had a chance to spend some time with Gary last week. And so we were looking at the economy and what's going forward. So I want to share a few slides. And then at the end, hang on with me because we're going to go through a really quick dive of affordability and home prices. And if you're getting anybody right now that truly says, like, I believe prices are going to come down, or I think that it's going to be more affordable later, I'm going to give you some quick tools to be able to kind of have a logical conversation with them. And so I want to kind of jump in, and I'm just going to share a couple of slides with you, right? And so are prices going to go down is a big question. And you kind of look at it and go, there's nothing to indicate from a fundamental level that prices are going to retract. Again, you've heard me say before, 3 months ago, we had 5 bottles of water and we had 30 people, looking to buy water. Now we have 5 bottles of water and we have, maybe 15 to 20 people looking to buy that water. We still don't have enough water for the demand, right? We still don't have enough supply for the demand. And so in just basic economics, right, increased demand and low supply is going to equal price increases, right? Now, the government does intend to stop that, right? They need people to stop buying houses. They need people to slow down buying homes. And so they're going to continue to raise our interest rates until you and I decide. We'll know when it happens. Gary says, we'll know when it happens when you and I decide that we no longer going to go out to dinner, or we're no longer going to go buy that car, or we're no longer going to go on that vacation because the cost to do it has increased so much that we make the decision not to do it. And so the government needs us to slow down on spending. And so that's what they're going to do. But as far as prices coming down on homes, you can kind of look here. Keep in mind, 6-month supply is pretty healthy, right? That's a balanced market as a 4 to 6 month supply of homes. Right now we're at days, days of what's out there. And so, homes are spending about 17 days on the market, according to April. And so one of the things that I like to think about is if you had a great year in 2022, you're probably going to have a great year, if you had a great year in 2020, probably going to have a great year in 2022. So it's a great slide. Also, if we go back and look at mortgage rates historically, we saw them get down to 3, but you kind of have this 5 or 6% line, the green line. And I'm going to get these slides. They're going to email them to us. These are just some photos I took, but I'll get the slides out to you guys. You kind of see the green line of where we're historically at during the 90s and the 2000s. And then the historical average, actually about 7.8%. And I'll be honest with you, probably, in my opinion, we probably at some point reached 7 or 8% in interest rates. And so we just want to kind of keep that in the back of our mind as we go through the next 12 to 18 months. They're going to continue to push those interest rates up because they're going to need to slow down the rate at which homes are selling, and that we're doing things, not just homes, but everything, right? And so one of my favorite slides here when people talk about home prices is if you look at the annual median home price, you can see this yellow line is the trend line. We said for years after 03, 04, 05, 06, 07, kind of see above the trend line. And then you see kind of the drop in 08, 09, 2010, and then the climb back up. And we said for a long time that the trend line might have reset. If you were to cut off what's above the yellow line and flip it, it almost fits exactly into 09, 2010, 11, and 12, right? And so the excess that we had in 2009, in 5, 06, 07, we gave back in 09, 10, and 11, right? So you saw that dip. And we don't see that dip very often. But when you follow that trend line up, it took, if you bought a home in 2007, and this is the conversation I want to have with the consumer, is when do you plan to move? Because if you bought a home in 2007, you had several years there that, 08, 09, 10, 11, 12, and then somewhere around, 13 or 14, you got back to par, right? So if you didn't move in those 7 years, your equity wasn't there, but ultimately, who cares, right? The average homeowner moves every, 8 to 10 years. And so if I look at years 8 and 10, they still made money. Even if they bought in 2007 and sold, they still made money on their home. And so what's interesting is 2021 and projected in 2022, average home price, again, above the trend line for the first time, huge spike here in prices. But you can see, like, according to the trend line, not that far above it. And so we'll see how that plays out. So I love that slide. I think it tells the real story of, yes, prices are up, but we also saw a huge dip to kind of recoup what we did over the line. And so that line, we should actually be at 343. So the average home right now is probably about $40,000, $42,000 above that trend line. So we'll have to see how that plays out. But until demand is then, really low and then supply is really high, you're not going to see those prices retract. And again, as long as you're focused on the long term, if they're going to buy and sell, or if you ask someone, when do you plan on selling? And they say in 3 years, then you want to go a little bit deeper on the conversation and go, okay, well, let's talk about the impact that could have, right? We don't expect prices to come down. We expect them to level off. But let's talk about the impact that could have in any market, right? If you're selling in that short term. And then lastly, right, some of the things we just want to look at here, annual home sales, again, 2022, think about it, 5.6, that line right there, if that's where we end up, that's still your 1, 2, 3, 4, 5, 6 best year ever in real estate. And so I know a lot of you have expressed some anxiety about what could happen or about the changes. So again, I think if you had a great year in 2020, probably have a great year in 2022. Again, even if it were to go down to 5 million with interest rates, and that's still 5 million homes, you are still, pretty high above. I mean, there's still only 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It'd be your 13th or 14th best year ever in the industry. And so just keep that in mind, guys, right? Like we're gonna make it through this, and the well-informed agent, the skill-based agent that is working on understanding and learning now is going to be the agent that takes market territory. There's a great slide in the Shift book that talks about holding your market territory, holding the number of units that you're selling steady. As the market comes down, your market share goes up. As the number of homes go down, your market share goes up if you're selling the same number of units. And that's where we talk about surviving the shift and then thriving during the shift. We want you to survive during the shift. It's going to be the same rocky ride for all of us for 4 to 6 months. So we want to make sure you have reserves and money you can live off of. And yet we're still going to sell homes, guys. It's just not going to be maybe what it has been. And as you survive through that shift, you gain market share as agents start to get out of the business, because it takes most agents about 6 months to realize that there's a problem. And so then you're going to look up, and while you're still there, there's fewer agents in the market, which means more homes for you to sell. And then you thrive out of that shift. And then after about 18 to 24 months, maybe 36 months, that market uptick returns, right? And you start seeing that growth again because of the economics at play. And that's where you really take off. And then you've got another 5 to 7 year run that you really are able to accumulate some wealth and do some really smart things. So long-term strategy, make sure you're thinking through that. All right, last, I want to make sure I honor your time today and don't take too much of it. We're going to continue these conversations around the economy and around the scripts and the things to do for our consumers so that they're well informed and well educated. I want you to think about this. I ran some math as far as home affordability, and I had some people mention this week that the common things they're hearing isn't. Remember, a month ago it was, well, if I sell, where would I go, right? And that was the big concern of the consumer. Now it's, if I buy today, am I overpaying for the house? And I'm worried about the affordability of the home, or worried about the long-term impact. What if I'm buying at the top of the market? Well, let's remember, people buy the payment, not the price. And so what we want to think about as far as affordability is concerned is that home prices are still, as a percentage of household income, relatively low or in line with what they have historically been. So I know prices are high right now, but what we want to think about is historically, as a percentage of household income, they're holding pretty true to what they should be. And so you can kind of look at that, think about that from a lending standpoint about front end and back end ratios. Your front end ratio is a percentage of your house or household payment as it's exposed to your entire income. So for instance, a $2,500 home payment, principal, interest, taxes, insurance, for a person making $120,000 a year or $10,000 a month, just for easy math, would be a 25% front end ratio. And 25% would be really good, right? Most banks expect people to be 33 to 38, maybe 40% on their front end ratio. And so if a bank would approve someone at a 40% front end ratio, or let's say a 35, a little bit more traditional, even down to a 28%, we'll call it 30% for easy numbers. You can take their income, if they make $10,000 a month, and say, okay, well, you should feel pretty good at a $3,000 a month house payment. And that's probably pretty conservative, guys. If you think about FHA, what they're willing to do, and then really the back end ratio with all of their other payments in, home affordability is still really affordable. So if you want more information on that conversation, happy to provide it. I think one of the things that you can do right now is get really well versed in lending and loans and understanding how people qualify at a really deep level will make you a great expert. Last thing I want to leave you with, I ran some numbers. Let's assume that the consumer is right. Let's assume that that kind of worst case sky is falling happens and home prices go back 10%. That would be unheard of, right? I mean, we saw it during the Great Recession. We saw it maybe during the Depression. So, once in 100-year kind of phenomenon. And back then people were breaking the law, and mortgage companies were pretty loose with their money, and there was no regulation oversight, which isn't happening today. So that's not a concern. But let's just assume they lost 10% in home value, right? If they bought it at $400,000 and it went down to 360, right? That'd be a 10% loss. The interesting thing is that I ran the numbers on a $400,000 home today, which is about average in a lot of our markets. Your principal, interest, taxes, and insurance at a 5.5% interest rate is $2,351, right? That's a rough estimate of PITI at a 5.5% interest rate on a $400,000 mortgage. So keep that in mind, $2,351. Now, I ran the numbers and said, what if I bought a $360,000 home at a 7% interest rate, which it's only about a point and a half, maybe closer to 2 points. They're coming down a little bit, but we will get there, right? And so if the prices go down, my interest rate's going up because that's what's going to actually drive prices to go down if it happens. So now I'm buying a $360,000 home. So yes, I saved money. I waited. I was smarter than the market. Awesome. But now I got to borrow at 7% in order to get that loan. My monthly payment is actually $2,396. So while I got a cheaper house, my payment is actually almost $45, exactly $45 higher, buying a cheaper home at a higher interest rate. And so we just want to help the consumer understand that, is that yes, the sky is falling scenario, Chicken Little, prices come down. Are they going to come down 10%? I don't think they're going to come down personally. And I don't have a crystal ball. And so we're all kind of guessing the best with the info that we have. So once you be able to have that conversation with your consumers, show them that buying a home at $400,000 at 5.5, or maybe today 5.25, is much better than buying a $360,000 home at 7%. The last piece that you put on there with that to tie that up for them is say, if you intend to live in your home for more than 5 to 7 years, definitely more than 9 years, then home prices have always gone up. Always, right? And that's a big word, right? Home prices have always gone up over a 9-year period, right? Just like the stock market has always gone up over a 9-year period, because the government intends for that to happen. They have to have that happen. So if you're going to buy a home and you're going to live in it for more than 5 to 7 years, the odds of it being less when you go to sell it, or you owing more on it than you have, are pretty low, right? So you can feel pretty safe about buying it. So again, we want to talk with them about buying the payment, not the price right now, about interest rates and how to make that a win for them. Guys, I hope that that's helpful. If there's specific information you want me or Ms. Nora to cover, feel free to let us know. We're happy to cover it for you. Talk to you soon, guys.